Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Sedan, and this week we're covering restricted stock units, or RSUs, and some of the basics of this type of stock. We cover RSUs as well as incentive stock options, non-qualified stock options, employee stock purchase plans, and more in Spidell's 2-hour Stock Incentive Plans on-demand webinar. A topic list and registration details are available at spidell.com under webinars. Unlike stock options, shares of stock acquired under restricted stock units are not purchased by the employee. Instead, they're automatically received by an employee through a vesting schedule provided in the employee's stock grant. An employee receives shares of stock and recognizes ordinary income when the RSU vests, equal to the fair market value of the stock on the vesting date. An employee does not recognize income when a restricted stock unit is granted. Recognition occurs as the RSUs vest because that's the time when the stock is no longer subject to a substantial risk of forfeiture. The ordinary income should be reported on the employee's W-2 or Form 1099 NEC if the RSU is vested to someone who's not an employee. The ordinary income is subject to Social Security and Medicare taxes. Because RSUs give rise to ordinary income when they're vested and therefore are reported on the employee's W-2, they're also subject to income tax withholding. It's common for employees to use vested shares to satisfy this withholding. For example, an employee may have 100 shares of company stock vest, but may only receive 70 shares. The remaining 30 shares are held back to satisfy the employee's withholding obligations. In addition to the ordinary income recognized on the vesting of RSUs, taxpayers will recognize capital gain or loss when they dispose of the stock. This is calculated by subtracting the stock's fair market value on the vesting date, which is the date when ordinary income was recognized, from the sale proceeds. The capital gain or loss is classified as long-term if the shares are held for more than 1 year from the vesting date to the date of disposition. When an employee's RSUs vest, the stock is transferred into the employee's brokerage account. The cost basis provided in the employee's brokerage account is the fair market value of the shares on the vesting date. Because the amount reported as the cost basis in the employee's brokerage account is the same as the amount that was reported on the employee's W-2 or 1099 NEC for non-employee recipients of RSUs, the basis reflected on the employee's brokerage statement should be accurate. But the basis isn't reported to the IRS because it's classified as a non-covered transaction. This means that if the Form 1099-B for the sale of the stock does not reflect any basis at all, which is often the case, then the tax professional will need copies of the regular brokerage statements to calculate basis. If you're looking for a deep dive into partnership and S-corporation issues, sign up for Spidell's 2023 Summer Tax Webinar. We'll be covering basis calculations and adjustments, making an S election, proportionate distribution rules, and how to prevent entity owners from being liable for entity-level taxes, plus more. You can register at spidell.com under webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.